and a bit of an outperformer too. By that I mean State Bank of India. What's really interesting is that State Bank of India has gained 20% from its low made in 2024. And if you take that date where it made its low in 2024, the bank Nifty is flat. So this is a clear outperformer. The question really is, what is it that's really driving State Bank of India? In fact, in the last 3 odd sessions as well, it has moved up by as much as 12 to 13%. And a lot is at foot. And for that, I have with me Vishwanath Nair as well as Hersh, Sayta, who's going to guide us and perhaps tell us a little more about what could possibly be behind this move. Vishwanath, I'm going to start with you. What do you have for us?
So I'm calling it the Giant's Age because SBI being the largest lender in this country and moving at the pace it is, everybody else is sort of in awe of where SBI is at this stage. Yeah. If you look at some of the negatives, now, of course, Q3 results came in about last week, and the numbers did show a bit of a disappointment. Primarily, the net profit did go down because of one-time wage-related and pension-related provisions that they made. This, the bank says, is likely going to normalize going ahead, but it's obviously a disappointment. The other thing was that even if you adjust for these one-time hits, the net profit's up only about 1.5% year on year. That's not looking so good.
Yeah.
If you look at fresh slippages, they are up largely driven by retail NPAs. There's lower recoveries and upgradations that have happened in Q3. So those are the slight disappointments as far as the Q3 numbers are concerned. But of course, for a bank like SBI, you need to look at a wider range of numbers. And for me, the moonshot sort of a situation for SBI is the fact that FY23, they ended at the decade's best credit growth, 16-odd%. It's tapered off to close to 14.5%, 15% now, but it doesn't look like it's going to slow down further from that point of view. Asset quality, best in recent history. You're seeing that despite the regulatory tightening on unsecured loans, the bank is continuing these unsecured loan growth at a reasonable level, about 16.5%, which is not too bad as far as SBI's size is concerned. You look at any kind of the capital adequacy. Now, of course, during the third quarter, there was a hit because of the RBI's unsecured loans, unsecured loan norms, 123 bips dip on a quarter-on-quarter basis. But what the bank is guiding is that going ahead, there's going to be improvement on the capital adequacy simply because of the business, the nature of the business that they're in. Investment book valuation that will come in from 1st of April. That'll boost capital adequacy. You've got ROE outpacing credit growth. That's going to help with capital accretion. These things are working in favor of State Bank of India.
Right.
Business per employee, now that's the important bit, because when you talk about wage-related or pension-related provisions, you have to look at what these provisions are leading to. As far as SBI is concerned, that business per employee number is at about 30 crore per year. That's a lot. That's a very high number. Considering, of course, SBI's large employee base, and they're not seeing that kind of high attrition that some of your private peers are seeing.
Right.
One point that I want to mention is on the corporate credit growth. Now, there, SBI is beating the private sector peers just hands down. There's no way that a private sector bank in the current business macro environment can compete on pricing with SBI. SBI is sitting at a reasonably healthy credit deposit ratio. They've got liquidity reserves, 131% or LCR. They've got, of course, deposits are still growing, 14.5%. They've got that in place. So unlike their private sector peers, that cost of capital or cost of deposits, as well as the lack of liquidity or tighter liquidity situations, does not seem to be affecting SBI that heavily. 4 lakh crore worth of additional SLR, unencumbered SLR holdings. All of that is just free liquidity lying around on the balance sheet for them to grow much faster. Right. But I'll move to Hersh for any view on the valuation of the bank.
Yeah, absolutely, Vishy. So before I go to valuations, let me just add a little bit to what you've said. I think, Vishy, what we were speaking about last evening as well, with regard to ROAs, that's going to hold the key, right, when it comes to SBI, including its valuations and how valuations are to be looked at. Now, ROAs have breached the 1% mark. They've come off that 1% given the one-offs that have happened. Probably another quarter of a bit of pain with regard to provisioning, because there'll be 5,400 crore of provisioning which will happen in Q4. And maybe that's a bit of an overhang with regard to ROAs. But can ROAs sustainably be above that 1% mark? At least analyst estimates seem to suggest that it will be, because they are penciling in a profit after tax FY25 of 70,000 plus crore as per Bloomberg estimates, average analyst expectations. And therefore, you will have that 1% plus ROA continue to come through at least in FY25 as well as 26.
Sure.
Right, which is a big plus. As you said, credit growth will be solid, but you know, the one other key perspective to this is with the ROA, I also want to try and comment on the margins, because margins, it seems, have bottomed now, and therefore there is very little downside scope for ROAs, right? That's just the general sense that we're getting, of course, based on estimates, etc. Now, with regard to valuations itself, you're seeing valuations at roughly 1.4. You're looking at PSU banks which have rallied substantially. Probably on a low free float as well, so let's give it a little bit of discount there. But at 1.4 times trailing 12 months, it's looking extremely good. And at 1.1 times forward, it's looking quite attractive basis your last 5-year average, which is roughly 1.4. So you're trading at your 5-year average, but you're looking at probably a year in which banks have had the best couple of years of run, and the runway seems to be quite solid with regard to the next 2 years in terms of visibility. So, so overall, it looks like despite this run-up, valuations still seem quite decent. It doesn't seem to be stretched in any way, especially for SBI as well as a couple of other larger ones like Canara Bank and Bob. But especially with regard to SBI, given the size.
Yeah, I just want to add one point, Agam. You know, during the results announcement, the management was very clear. They don't need the capital. They're about 13%, 100 bips higher than the regulatory minimum. They're fine as far as the growth is concerned. If they need to, they're ready with a capital raising plan. You know, just listening to the valuation bit, I'm thinking that if there was to be some kind of a QIP or an equity raising plan, SBI is going to be pretty well placed as far as your capital position is concerned, as well as market valuation is concerned. This is important in the current environment because most banks are seeing some amount of you know, movement on the valuation front, simply because business has changed. Last 2 or 3 years have been a period of fairly easy liquidity. Now it's tightening. Now businesses are sort of becoming slightly more complicated on the banking front. So SBI may be best placed to capitalize on any future growth.
Sure. You know, I just want to put things into perspective because we've seen a sharp divergence in the way SBI has moved and HDFC Bank has moved. And it's natural for anyone to compare the private sector banks with the state banks. How do you think this pans out? What do you think investors have at the top of their mind at the moment?
I'll tell you what, during the analyst call that SBI held after its results, they said that they have headroom to grow the balance sheet by about 7.5, 8 lakh odd crore. That's a massive number, right? HDFC Bank is saying that every 4 or 5 years, they're going to add another HDFC Bank. Well, here you have SBI, which is doing pretty much the same thing and at a much higher base. So if you look at it from that point of view, there's a lot of firepower that's left with SBI at this stage. Now, I want to caveat this with, we have seen this in the past. And it didn't really pan out the way people planned it, especially, you know, chief of all these banks. Let's see what happens. We can't write off HDFC Bank yet because at the end of the day, it is one of the most efficient lenders that we have in India. Can't write off HDFC Bank as SBI doesn't look weak in any comparison at this point.
Well,
And Agam, on valuations, you're looking at a sharp divergence. You're looking at HDFC Bank trading just above 2 times price to book, and you have SBI trading just above 1 times price to book. So from a valuation perspective, SBI is probably trading at a 50% discount.
Right, absolutely. So of course, to a certain extent, the state bank valuations have always been, you know, low as compared to the private banks. But a lot of factors, a lot of points to ponder about when it comes to State Bank of India, which clearly is at the moment in the driving seat, quite literally, even in terms of stock prices and the way things have panned out over the course of the last few days in the Bank Nifty, among the Bank Nifty constituents. The question really is, where do we go from here, and how does the private sector bank sector play out in going forward? Well, these are questions that will be answered down the line. But Hersh and Vishwanath, thanks for joining us and getting us that perspective